Introducing our new series of intimate in-person trading conferences in some of the greatest cities in America. It's Market Rebellion Live. Next up, this June in Sonoma County, California. Savor some of the finest wines in America while you level up your trading with Pete Najarian, John Najarian, AJ Monty, Ryan Mastro, and Bill Johnson. Sonoma is limited to just 25 seats to ensure every guest gets personal attention, so act now. Tickets are going fast.
Hey, good afternoon, Market Rebels, and there's that sound, Stu. There's our closing bell. I think we were up.
That must be the bell. There you go.
Like 300 points. I think I read best close in 2 months for the Dow. So pretty cool, right there.
Yeah, almost 400, up 383.9.
Oh, folks, almost 400. Okay, very nice.
Yep, little 1%.
Yep, big day. So anyway, welcome everybody and to all of our Market Rebels and to our YouTubers and people who might not be part of Market Rebellion, but we'd love to have you join us. But we have all kinds of cool information and our Twitter people, can't forget them. And just to help you have a different perspective on options trading. And that's really what we try to show you here on Coach's Corner. We're not here to teach you the basics and what a covered call is and your break-even points and stuff. We certainly can, but that's not where the money's made. And so today, Stu and I decided to kind of take a little different tack than we normally do, a little bit more of a philosophical side about trading and understanding what to look for in trades and why so many people miss the opportunities.
But hang in there because it's going to be so applicable to everything that you do in the options market.
Absolutely. It might not seem like it at the beginning, but we are heading up somewhere. So hang with us.
Give us a shot. Yep.
So anyway, we're going to start off with our chalk talk. This is also going to be a little bit different. Normally we have a question that we answer at the end. We're going to take a little bit different tack and give it more of almost a mini presentation that will be answered during the presentation. So we're not going to answer that at the end, but it's important to set up for the actual presentation. So the chalk talk thing that we're going to talk about here today is the Monty Hall problem. And I'm sure that many of you have seen this. It's been around for a long time, and it's got a lot of different applications. But for those of you who might not be aware of it, you've probably seen the game show, Let's Make a Deal. Monty Hall.
Let's make a deal.
And so what he would do when they have all these weird kind of games and stuff, and people dress up in funny costumes. And so one of the games they would do is they put up 3 doors. And they might have, let's say, a Cadillac or a trip to Paris or something that was the definite prize. Then you'd have some other little duds. You might have a goat or something that just was a real good prize. And so it was, they'd pick a contestant and it would go something like this. A contestant says, I'm going to choose door number 1. And so the game show host, Monty Hall, would say, okay, I'm going to reveal a door for you. And let's just say that he picks door number 2. And it happens to have the goat. And the question is, should you switch? So this was a question that was posed in a magazine called Parade Magazine to a columnist named Marilyn Vos Savant, who is reported to have the highest IQ, not just of a woman, but of anybody ever in history. I think it's like 226. I mean, literally just off the charts. And she had this column, and a statistician...
Bill, isn't yours higher than that?
Yeah, not even close. Roscoe's is.
Okay.
But a statistician had posed this question to her, and she said that you should. And she got absolutely roasted from around the world. And people were saying that she was just wrong. You know, nice try, Marilyn, stuff. Well, let's find out why she said that you should switch. So, as always, if you're interested in trading, please visit marketrebellion.com/get started. Lots of great stuff and free information, free videos to help you get started. So again, Marilyn's answers.
Take a minute, everybody, and just, what's your answer? Should you switch? Think about it. What's your answer? Should you switch? Write it down, commit. I can tell you that my answer, my instinctive answer, is incorrect because
to switch.
I mean, I'm thinking like, 3 doors, everyone's it's 1/3, and that's it. What's gonna happen? But what we're going to show you, and what you need to think about every day in the marketplace, is there are things out there that you don't see and that you can't recognize unless you're really looking for them. It's the things that you don't know that you don't know. It's the things that help you to make decisions. And instinctively, as a trader, you kind of have to think about, well, maybe that answer is incorrect.
Yeah.
What do I have to do to get to the to kind of find it? So go ahead, Bill, take it away.
So anyway, in her column, Marilyn said that you should switch and you would have a 2/3 chance of winning. And again, she got this backlash from around the world. And I'm talking from distinguished statisticians saying you're flat out wrong. You need to go back and take some basic math, et cetera, et cetera. But part of the problem here is that there was an unstated assumption. The statisticians were assuming that all 3 doors would have been equally likely to be, or the other remaining 2 would have been equally likely to be picked from the game show host. But Marilyn said, well, the host is never going to reveal the prize. So if door number 1 in my example there if door number 3 has the Cadillac, she's not going to reveal it and say, bummer, sorry, we screwed up that game. Let's move on to the next one. But she felt that it was so obvious that she didn't need to state it. And the statisticians who were battling with her just assumed that they all had an equal shot. So here's a really neat way. I talk about this in Q&A classes. If you're ever stuck with something, it helps to look at things in an exaggerated fashion. Talk about it when we look at pricing models and what happens when interest rates tick up a tick. Yeah, and you're going, well, I can't figure that out. Well, imagine that interest rates go to 20%. And suddenly it starts to shed some. It's just it helps you to get
the ends and work your way in. It really helps perspective.
Yeah. So here's a way that you can kind of come to the same conclusion. Instead of saying that there's only 3 doors, there's a bunch of them, maybe hundreds or thousands, tens of thousands. And now you pick 1 door. Now think about it here. Are you more likely to be right or more likely to be wrong? Far more likely to be wrong. So now the game show host turns over every door but 1. And now the question is, should you switch? Well, now it becomes obvious. You're saying, okay, the chances that I had it were virtually 0, but now it's obvious that must be where it is. Right, because I know that they're not under any of the others. So it's far more likely to be there. And in fact, there's a very high probability, almost 100%, that it's there. That's really what happened with the 3 doors, is that if the host doesn't reveal the prize, then what happens is that effectively that probability gets transferred to the other door. So it gives you a 66% chance of winning under that assumption that he's not going to ever blow the game by revealing the prize. All right, now I want you to think about this for a moment and put it off to the side.
Which gives you an edge in that circumstance.
Oh, for sure.
Having that 60% gives you the edge. It's not 50-50 anymore. It's now higher than that, and that gives you an edge. Right.
So what we want to show here is really the beginning of our Coach's Corner right now. This is our chalk talk, but it was just to be a little refresher about this problem. It's been around for a long time. You can look it up on Google, called the game show host problem or the Monty Hall problem. But now I want to come up to something different. And then we're going to look at something really interesting. And we're going to call our show here today Hidden Edges, because as we said, this is really an important thing for traders to understand philosophically when you're trading. Everybody wants to look at the positions in their account. They see I've got stock, I've got a long call, I've got a short call, I've got the 70 strike, I've got April expiration. We can see it, but we never think to look at the things that we don't see. And yeah, it sounds like a weird concept, but that's really the professional mindset. So now we're going to look at a second game. And this one we're going to call a guessing game. I happened to stumble upon it in a book. There's a couple of videos out there on YouTube that talk about it as well. But what we're going to do is to pick two numbers. So Stu, I want you to jot down two numbers. It can be anything at all. And this is part of the thing. They can be anything. You could pick 27 billion. You can pick decimals. You can pick fractions. It really does not matter. Okay, so you got your two numbers. Okay, so we're going to have you write those down on a piece of paper, and we're going to turn them face down. And then we're going to turn over. So go ahead and pass your numbers over to me. I promise not to look. All right.
Okay. All right.
And
there you go.
All right. And what I'm going to do is I must guess if the second number is bigger than the first. And we're going to have a bet. We're going to just bet dollar for dollar, even odds. That sounds odd. Even odds. Anyway, the question is how, or could I possibly have an edge? So here's Stu's two cards. And let's say we flip over the first one and it's 1,000. And the question is the second number bigger or smaller? Now you might think, got to be 50-50, right? Because beforehand, I had no idea what he was going to turn over. And the question is, can we possibly find an edge in this game?
Let me step in here for one
second.
Assuming that, we're not saying when 1,000 is 1,000 away from zero and 1,000 is,
right,
billions and billions of infinities, we're talking in a reasonable environment. You could very well say that the 1,000 is 582 trillion. I mean, it doesn't really matter. It's just,
or you could say it might look like you say, oh, it's closer to zero, and therefore the probabilities that it's bigger. But remember, it could be anything. They could be negative numbers. He could have gone to negative 50 billion. We don't really know if 1,000 is big or small. It could be any number at all. So right, now we have to say,
is the next one bigger or smaller? That's it.
Yeah. So if you really think about it, you'd have to say probably a 50-50 shot.
Yeah.
But there is
that would be the reasonable.
That would be the reasonable thing. And I think most people would take an even up bet dollar for dollar on that. But there is a very fascinating, ingenious way to capture a significant edge. And what we're going to do, it's actually a few tricks, but this is actually one of the simpler ways to visualize it. We're just going to generate a random number. So maybe I go into Excel and I have it pick a number.
Any number. Doesn't matter.
And I'm going to compare my selection, my random number, to Stu's overturned card. And depending on where it falls, now I'll explain that in a moment, I have a way of capturing a very high edge of winning in the long run. And here's the way that it works.
Now remember, you had a 50-50 shot here. It's either over,
at least it appeared. Right.
That's what you're thinking about. It's over, it's under, or it's over. So right. Go ahead. Keep that base in mind. Under or it's over.
So you would think that that's the case here. Well, let's say that my random number is 800. Well, I'm just going to say that A must be greater than B. And I'm going to have a 50-50 shot because in this case, my random number does me no good. It's outside of the range. But let's say that my random number comes up to be something bigger than both. Now, of course, I don't know this at the time, but let's say it's 3,000. I'm going to say, all right, well, in that case, B is bigger than A. Still a 50-50 chance. So right now, it doesn't help me, but it doesn't hurt me either.
Nothing changed yet.
Nothing has changed yet. But if I happen to get lucky and have a random number that falls between Stu's two numbers, I will win 100% of the time. So let's say that my random number was 1,500. Stu's first card is 1,000. Now remember, he doesn't know that I did this before the thing. We flip over this card. I look at my random number 1,500. And I say, all right, by definition, if 1,500 is in the middle, what does that tell you? B has to be bigger than A. And so we flip it over 100% of the time. That's the definition, right? If we go from 1,000, 1,500, 2,000, 1,500's in the middle. The only way it can be in the middle is if 2,000 is big, if the card B is bigger. So now I'm absolutely certain that B is bigger. However, what if Stu had flipped them? What if he did this? Well, now I'm going to look at my random number of 1,500 and go 1,500 is less than 2,000. And because it's in the middle, I know that card B must be smaller. I will win 100% of the time. Now, because of this little scheme, I will win 66% of the time. Going, hey, wait a minute. Isn't that kind of like the Monty Hall problem? See what's happening that I'm going to have, well, actually, let me show you what's going on here, and then we'll find out where that 66% is coming from. So in this case, take a look at the spaces here. See, that's the thing.
These are the things.
This is the thing that people miss. It's the Monty Hall problem in disguise. See, when we were back here, yeah, people were focusing on the things that they can see. We see the two pieces of paper. We know that's the game, and that's what we're focusing on. But we don't look at the spaces in between. These are opportunities out here.
Like you have 100, 110, you have 100, 120 spread on.
Right.
You're not seeing the 102 and a half, the 105s, the 107 and a half, the 110s, the 112 and a half, the 115s, the 117. You don't see them because you're focused on the one that this, right. This is how you can migrate this mindset into trading. Go ahead, Bill.
Correct. So the point that I was showing here is it's exactly the same problem. So what's happening if my random number falls in the middle? Remember, we've got thirds, equal thirds. So if I win here 100% of the time, that's 1/3. But when we landed out here, I wasn't helped, but I wasn't harmed. I'm winning 50% of 2/3 of the time. So that's an extra third. That's why it's coming up to 2/3. So it's 66%. Exactly the same problem, but nobody sees it because they're focused on the things that they can see, not on the empty spaces in between. And this can be such a super powerful, again, it's a little bit more of a philosophical thing. Stu and I talk about this all the time and how people miss the opportunities because they're just focused on the things that they can see. And that's why we tell people.
We had a trader in our Q&A session today. I'll just call him, Harry. Names are changed to protect the innocent. And the gentleman was asking about hedging. And the piece he was missing, the card that he didn't see was, well, what will the hedge do to the entire position? As opposed to the base, which would be the original two cards. I know what's going to happen. If I own the stock and it's 120 and it goes to 100, I know what's going to happen because I know I have 100 shares and it's going to be 20 points. So I know it's going to be $2,000. But what you don't really see is, or what people strive to figure out is, like, if I put on a hedge, what will the hedge do for me? How to price those extra pieces of information into the equation of pricing principles, of pricing the pricing model, and then coming up with an answer of, well, was it enough on that proposed outcome? Was that hedge enough? Did I have to give up too much to get what I was looking for? Or where can I find a compromise to make me sleep at night and also give me an opportunity if I'm wrong on needing a hedge? These are all things which the professional trader must think about in order to excel and manage a position moving forward, not moving back, but moving forward.
Right. Absolutely. So we're going to show you some examples. Before we do, as always, please remember marketrebellion.com/get started. Free stuff. You can't beat that. You can't beat the price when it's free. Free information, free videos, a lot of things to help you understand more about options trading and why they are becoming, and really have been for so long, becoming more and more popular, especially in these markets. So now, what does this really have to do with trading? Okay, that was more of a philosophical look at it. But how can we show you some examples? Tons of them. Tons of them. Let's take a look at it's never ending. Let's take a look at a butterfly. Here's a 100, 110 butterfly. And for those who may not know, we're going to be long a strike, short two at a higher strike, and then long one at yet a higher strike. They're going to be equally spaced, so 100, 110, 120.
And it doesn't matter if you're long or short. It has nothing to do with that. It's just you have positions at 3 different strikes, and they're a position. It has 3 components, so it actually has 4. But you got to think about what's not there. Go ahead, Bill.
Yep. So the question is, do you see one butterfly? And most people who study definitions, they'll say, oh, yeah, I know what a covered call is. I know what a butterfly is because it's in a 1 to 2 to 1 ratio. This is one butterfly. And so while they're trading and finding out that things aren't going as they expected, which they never will, things change. Time's going to pass. Stock's going to move. Volatility's going to change. And they sit there and just go, gee, what do I do? So what am I going to do? Well, let me just close it because I don't know what to do. Well, the thing is, you're missing the areas that you're not seeing, exactly like the problems that we just showed. There's actually a smaller butterfly in here, just like Stu was talking about with the vertical spreads. These are called embedded butterflies. There's another one, there's two there, and there's another one here. There's actually 4 butterflies. Now, just to show this, I went into a pricing model, put some parameters in there, volatilities and stuff, and I did a 100, 110, 120 butterfly, came up to a price of 386. Now check this out. The 100, 105, 110 butterfly, which is here in blue, was priced at 94 cents under that same model. The 2 here in red were $1.03 each, and the 1 in green was 86 cents. So if we take these 4 and add them up, what do we get? It is magic. Really That's and truly exactly the same thing. If you bought this butterfly, sold these twice, and bought this, you would end up with this one in the account. So the point is, as a professional trader, let's say obviously we want the stock to stay at 110, but it moves out slightly. Well, maybe the 100, 105, 110 is getting close to maximum value. Maybe we should spin that out of the position. There's something to trade because we're looking at the things that you don't see. Because we know to look.
Maybe it's just the 100. Maybe it's just the 100, 105, which you're not.
It could be exactly. It could be a vertical. Very good. It could be a vertical spread in there. Maybe the short vertical.
He's trading at 490, and hey, now it's a danger. Dump that.
Yep. Could be the short. Could be the short verticals. Could be any number of things. Now, as we start spinning these out, we might end up with vertical spreads, with condors, with broken wing butterflies, and that's why it helps to understand what you're looking at in the strategies. But the thing that we wanted to show here is that it's very easy to miss the things that you don't see. Now, what if we had a 100, 120, 140 butterfly? Notice that these are separated by 20 points instead of 10, and that's going to change things. We actually have 1, 2 there, 3 there, 4 here, 3, 2, and 1. We actually have 16 butterflies in there to manage.
And these are on 5-point strings.
Yep. We could do, there's a little mathematical trick we could do here that if these are, let's say in 5-point increments, 100, 105, 110, and 15, 20, that would be 4 steps to go from 110 to 120. And if you take 4 squared, it's going to tell you the number of butterflies that you have. So these are some ways that we can say, all right, if you're out there trading one butterfly and struggling and waiting, chances are these other butterflies might be moving in your favor. And guess what? You're missing them because you never thought to look there. You're looking, but you're not looking at the spaces.
One point here is you don't have to know how many butterflies are in here. I mean, is it cool to know? Yeah. The point is there's things inside of this that you must look at in an effort to delineate between risk, which should have a reward, and danger, which has no reward. Yep. And when you start crossing that line, now you got a problem as a money manager.
Yep. So speaking of dangers, here we go. So you've heard Stu and myself talk about this a lot. It's a little bit of a play on words, but in the financial business, we talk about risks, which are uncertainties, things that we accept in pursuit of profits. But then there are things that we call dangers. And a danger is a situation when you have a position on that can no longer help you, or maybe by a very, very small amount, but it could certainly hurt you. And so this is another area that traders miss all the time. So for example, let's say this is a $70 call. We've got our strike bend right there at 70. And I think when I did these prices, I think the stock was up at around 110 or 15 up into here. It was a deep in the money call. So here's our bend down here. And the question is, where's the danger? People go, I don't see a danger. It's just behaving like stock up here. Well, we have to look down here at the benefit. This is our insurance policy. And we've got the $70 call. So notice if we are long the 70, if I sell the 70-75 vertical spread, what is that? Look at that. That's a short vertical. That's going to cancel out my long. And this is really the idea behind rolling, but people often don't understand why or when we roll. Yeah, it's nice to sell the vertical and say, I got a credit. That's not why you do it. The real reason is that we have a vertical down here. We have another vertical here. We've got one here, right here, and all the way up the line. A long call position is a series of verticals because I could just continually roll that and walk right up the line. So when should you sell a vertical spread? So if we got a 5-point spread, maximum's what, Stu?
Let me see. Should I get my calculator out?
Calculator
okay,
out.
$5.
$5 is the very best it could be worth. So if it's worth $5, it definitely has to get out of there. But if it's, let's say, $4.90, definitely needs to go too. So now the $70 call at this point.
Sidebar, timeout.
Yeah.
Those of you who are looking at your platforms and are looking to sell a $5 vertical spread, and it's setting up as a midpoint, and it's only because of the width of the bid and the ask, and it's setting up on a midpoint of 520.
Right.
And you put it out there for sale, and you're asking yourself, why isn't it trading? Hey, I'm going to go down to 515. Why isn't it trading? I'm going to go down to 510. Why isn't it trading? Guys, gals, whomever is listening, I urge you to call 1-800 Rebellion. Get yourself some education. Get on the site. Figure it out. Figure it out.
This is the essence of trading. It is not about, let me buy a call because I think the stock is going higher. That's going to get you hurt. So if we look at the $70 call with the stock up here around 110, it was trading for $40.70. And the question is, what was the 70-75 vertical worth when the stock was up here? We go into the pricing model. It's worth $4.90. That is no longer an asset to you. That's a big fat danger. It's got to go.
Danger.
That's why we roll it. But most traders say, oh, I roll it because I just sweep in credits and I'm getting paid. Let me just keep rolling. And you're making radical changes to your deltas, to your gammas. You're probably doing things that you don't want to do. But this is one where you have to. Did you see this? Probably not, because it wasn't there. You have to know where to look. So one of my favorite quotes from Claude Debussy said, music is the space between the notes. And it's very much the same thing. It's a great quote, isn't it? It's very much, it's a different way of looking at it. Most people say we hear the notes, but the notes are just, it's a sound. What gives it the music is the spaces and the rhythms in between. And it's the same thing with the trading. Yes, you might look and say, I've got such and such a position in my account, but there's a lot of things around it that you could trade, hedge, roll, or morph into that you don't even consider. Why? Because you don't see them. So we just said, like I said, it was a little bit more of a philosophical look at trading. And if some of this caught you by surprise, we don't know of any other better way to tell you this is where the mindset of a professional trader or somebody like Stu, 29 years as market maker and specialist on the Philly floor, can really come to your rescue. So that's all we wanted to present. Stu, any closing comments?
Yeah, this is what we do. This is what all of us do here as coaches, Bill as an instructor. This is what we do. We talk about our goal is to get you to look at things, to think about things in a different way than you ever dreamed possible, to make you more aware of your surroundings so you can be a better trader and a better investor. Right. People talk about what's the better strategy. It's not about that. It's about you having the ability to make those decisions. And that's our mission statement here. That's what we try to do.
You can only control your actions. You can't control what the market's going to do. But if you have a much bigger menu to select from, you're going to do much better. And part of that means you have to understand how to look between the spaces. And so with that, hopefully it gave you some things to think about. And we hope to see you on Cocktail Hour at 5 p.m. tomorrow Eastern. Have a great weekend, and we'll look for you next Thursday on Coach's Corner.
Bye, everyone.